Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer two more Ask James questions of the day. First question is from Lewis, and he says, so are we in a bear market? And James, what is a bear market? It's a good start, right? Lewis, great question. Here we go. A market correction is considered when the market is down 10%. And a bear market is considered when the market is down 20%. It's kind of arbitrary. It's an arbitrary line. But then the question is, what is the market, right? Is the market the Dow Jones Industrial Average? Is it the S&P, the Standard & Poor's, the S&P 500? Is it the NASDAQ? Now, most people would say the S&P 500 is the market. And at the lowest point, we got down near 20%, but we didn't officially click into bear market territory. We got down under 5,000 on the S&P 500, really close, and then we bounced up, and we've been maintaining a good distance away from 5,000 for a while. Now, the NASDAQ actually was down a lot more, so the NASDAQ, yes, is in bear market territory. Is the market a bear, is the overall market in bear market territory? I'd say probably no. But again, it's just a number. Right? The bottom line is we've seen a huge run up. If you look at where the S&P 500 is right now, if you look back a year, it was actually slightly lower a year ago, even though we've come off the peak. It's really like blowing a lot of froth off the top. The reality is still, people have made money in the last year in the market if they were in the Standard & Poor's 500. So, okay, bear market. Even if we did click over that 20% and bounce back up, I would still say it's not a big worry at this point, simply because, again, we've still made money, right? You're not going back 2 or 3 years and say, gosh, I made money over the course of a year only to be, I'm still in the black over the course of the year. So that's when markets make it up rapidly, right? They make up losses rapidly at the tail end. And they have to get that kind of irrational exuberance, if you will, right? They're often, as a pullback kind of thing. So this is especially important for those of you who are nearing retirement and focused on investing for income. These market fluctuations, while they grab headlines, they shouldn't drastically change your long-term income strategy. Remember that dividend-paying stocks and interest-bearing investments often continue providing income regardless of short-term market movements. That's why we always emphasize having a diversified income portfolio that can weather these market cycles. So there's really 3 big reasons actually right now for the market decline. Number 1, government spending, right? Keep spending. Number 2, AI was hot, now not so much. And 3, softness in the market kind of caused by the tariffs. Tariffs was really the scare that started this slide. Hey, thanks for the awesome question. If you have a question and you'd like to send it in, you can email it to us at poollocke@poollocke.com. All right, let's jump into our second question from Kevin. He says, I'm within 10 years of retirement and most of my money is in my 401k. I'm still very growth oriented because I need to catch up for lost time. All right, Kevin, I don't know how old you are, but if you're within 10 years of retirement and if you feel like you need to make up for lost time, I'm going to guess you're probably over the age of 59 and a half. And as a result, here's the only thing that I'd be careful of. In a bull market, when things are going well, you can get growth by just blanketing the market, right? You can have a 60-40 portfolio or an 80-20 portfolio. You can be in the S&P 500 index and the whole index goes up. And by the way, most mutual funds kind of sort of track the index, right? So you could be in most mutual funds, and when the tide comes in, all the boats rise. So you can make money and feel like you're catching up on a total return basis. The problem is, in a questionable stock market, whether there's a bear market or a recession or even just an economic slowdown, but without a recession, right, you still have the problem of the fact that, generally speaking, the tide isn't coming in. Now that doesn't mean that you can't make money, but you've got to make money in certain sectors. And that's when picking the right sectors actually starts to make sense, not just blanketing the market or buying mutual funds. So you've done well over the long run with mutual funds, and you've done well in the most recent years with the mutual funds in your 401k. My concern is with what's looking to be either an economic slowdown or maybe ultimately an outright recession is that's going to be, it's going to be really difficult for you to continue to make money or to catch up for that lost time, if you will, so to speak, in that 401k. That's why I often suggest that people in your situation consider transitioning at least a portion of their portfolio toward income-producing investments. Things like dividend aristocrats, stocks, REITs, preferred stocks, even certain bonds can provide growth and income. This approach can help protect your nest egg during market volatility while still providing the potential upside you need. Here's why. Here's why I'm hoping you're over 59 and a half. Not because I want to push you closer to your life expectancy. No, that's not it at all. But it's because with most 401ks, if you're over 59 and a half, you can roll that money over into an IRA. Why is that important for you? Because in the 401k, you're probably limited in these mutual funds, right? And the mutual funds blanket the market, and they just aren't best suited to help you in this type of economic environment. But when you roll it over to an IRA, the universe of investment options opens up to you. And a good income specialist, a good person who specializes in getting people through that kind of red zone heading into retirement can help you a lot better than the vanilla flavored mutual funds sitting in your 401k. So I'm hoping you're over 59 and a half or close enough to it where you can take advantage of that ability to do an in-service rollover with your lump sum to an IRA, and you'll get that growth you're looking for to play catch up. Remember, as you get closer to retirement, it's not just about accumulation anymore. It's about preservation and creating reliable income streams that can sustain you through what could be 20, 30 years of retirement. Great questions today. As always, if you would like to send in your question, you can do so by emailing them to poollocke@poollocke.com. If you like what you heard, go ahead, like and subscribe to our channel. This is James Locke, your retirement income source. See you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear.